Most people believe professional investors win because they are smarter. They read faster. They analyze deeper. They predict better. That belief is comforting and completely wrong. Professionals don't win because they think more. They win because they think on a different operating system. Retail investors and professionals may look like they're playing the same game, same charts, same companies, same news, same market. But internally, they are not even close. Most investors are running what I call human default OS. It is emotional, reactive, narrative-driven, reward-seeking, pain-avoiding. This OS evolved to help humans survive danger, not to survive probabilistic environments like financial markets. The market does not punish lack of intelligence first. It punishes unoptimized thinking systems. Here is the uncomfortable truth. If you put a professional investor and a retail investor in front of the same opportunity, the outcome is already decided before any analysis begins, because the difference is not what they see. It is how their brain processes uncertainty, time, and loss. Think of an investor like a computer. You can give two computers the same data input, but if the operating systems are different, the output will never be the same. Investor OS is not a strategy. It is not a portfolio. It is not a checklist. It is the internal architecture that governs how risk is perceived, how time is valued, how uncertainty is tolerated, how decisions are made under stress, how losses are interpreted, how boredom is handled. Professionals do not rely on motivation. They rely on structure. Let's break the Investor OS into its core modules. Module 1, probability thinking, not prediction thinking. Retail OS asks, what do I think will happen? Professional OS asks, what range of outcomes is possible, and what is my exposure to each? Retail investors chase certainty. Professionals accept uncertainty as the base condition. They do not need to be right. They need to be less wrong than the price implies. This single shift changes everything. No emotional attachment to outcomes. No identity tied to predictions. No shock when reality diverges. The market is not a test. There is no correct answer sheet. There is only distribution of outcomes over time. Module 2, risk first, return second. This is where most people completely misunderstand professionals. Retail mindset, how much can I make? Professional mindset, how can this hurt me, and can I survive it? Professionals assume they are wrong by default. Their first instinct is not optimism, it's damage control. They design decisions so that being wrong does not end the game. Errors are small and recoverable. Survival is mathematically favored. Return is optional. Survival is mandatory. If you ever wonder why professionals look too conservative, it's because you are looking at returns while they are looking at ruin probabilities. Module 3, time as an asset, not a variable. Retail investors treat time as something to endure. Professionals treat time as something to exploit. Retail thinking, how long until this works? Professional thinking, is time working for me or against me? They structure positions so that waiting increases expected value. Inaction is not neutral, it is productive. Patience has a mathematical edge. Professionals are not patient because they are virtuous. They are patient because their structures reward patience. Boredom is not a problem to solve. It is a signal that the system is working. Module 4, emotion containment, not emotion elimination. This is critical. Professionals are not emotionless. That is a myth. They feel fear. They feel doubt. They feel regret. The difference is not emotion. It is where emotion is allowed to exist. Retail investors let emotion influence decisions. Professionals let emotion exist outside the decision layer. They do not ask, how do I feel about this trade? They ask, does this fit the system I already designed before emotions appeared? Emotion is treated like noise, acknowledged but not obeyed. Module 5, pre-commitment over willpower. Retail investors trust willpower. Professionals distrust it completely. They assume that under pressure, they will panic, they will hesitate, they will rationalize, they will override logic, so they pre-commit. Rules are decided before exposure. Exit conditions are defined before entry. Position sizing is locked before conviction forms. By the time emotion arrives, there is nothing left to decide. This is not discipline. This is engineering. Most people believe becoming a better investor means more information, more intelligence, more confidence. But professionals quietly optimize something else. They redesign the system that produces their decisions. If you still believe investing is about being smart in the moment, you are already playing the wrong game. Here is the insight that permanently changes how you see investing. In moments of stress, uncertainty, and drawdown, you will not act according to what you know. You will act according to what your investor OS allows. Knowledge is fragile, conviction is fragile, confidence is fragile, systems are not. Professionals don't trust themselves to be rational under pressure. They trust the structures they built when they were calm. Once you truly understand this, you stop asking, what stock should I buy? What market is next? What strategy is best? And you start asking the only question that matters. What operating system is running my decisions right now? You cannot unsee this. There is nothing here to follow, nothing to subscribe to, nothing to copy. Either you begin redesigning how you think, or the market will continue charging you tuition, silently, relentlessly, over time. By now, one thing should be clear. Professional investors do not rely on a single mental trick. They operate on multiple layered systems, each handling a different dimension of reality. Most people try to fix investing at the surface level. Better indicators, smarter entries, faster reactions. Professionals fix it at the architecture level. At the core of every durable professional is a three-layer investor OS. Risk OS governs survival. Time OS governs compounding. Decision OS governs behavior under uncertainty. Miss even one of these, and the entire system eventually collapses. Let's break them down. Retail investors talk about upside. Professionals talk about what ends the game. The Risk OS is not about fear. It is about irreversibility. Professionals understand one brutal rule. You can recover from being wrong. You cannot recover from being wiped out. So they design risk before they design returns. Key characteristics of a professional risk OS. Losses are capped by structure, not hope. This is why professionals often appear slow, boring, or overly cautious. They are not optimizing for excitement. They are optimizing for longevity. Retail investors ask, what's the best trade right now? Professionals ask, what mistakes would permanently remove me from the game? Once you adopt this lens, you stop chasing maximum upside and start engineering asymmetric survivability. That shift alone eliminates most catastrophic errors. Most people think they are impatient because they want money faster. That's not true. They are impatient because their system punishes waiting. Professional investors redesign time itself. They do not ask, how long will this take? They ask, what does time do to this position? In a proper time OS, waiting increases expected value. Doing nothing is an active decision. Time decay works for you, not against you. Compounding is structural, not motivational. Professionals love time because they have aligned it with their advantage. Retail investors hate time because waiting feels like risk. This is why professionals can sit through sideways markets, long drawdowns, boring stretches, while retail investors feel emotional pressure to do something. Time is not neutral. If time stresses you, your system is misaligned. This is the most misunderstood part of professional thinking. People assume professionals make better decisions. In reality, they make fewer decisions under pressure. They eliminate choice before stress arrives. The decision OS is built on one assumption: under uncertainty, human judgment degrades. So professionals design systems where decisions are front-loaded. Rules replace improvisation. Emotion arrives too late to interfere. They predefine entry conditions, exit conditions, maximum exposure, invalidation points. By the time the market becomes chaotic, there is nothing left to figure out. Retail investors feel smart because they are constantly deciding. Professionals feel calm because there is nothing to decide. This is not rigidity. This is psychological risk management. Why do 90% of investors fail to maintain this investor operating system? There are hidden costs that rarely get discussed. Even if the system works, not everyone follows it because the investor OS is psychologically expensive. Let's break down which costs most people cannot tolerate. The first cost is boredom. This investment system works best when nothing happens at all. But most people mistake boredom for failure. They feel uneasy and restless during quiet periods, losing trust in the process just because it doesn't feel exciting. Second, there's delayed gratification. In this system, results come slowly and often very unevenly. There are many long stretches with no visible validation. Most people lack the patience and discipline to keep going without immediate feedback or quick wins. Next is social discomfort. You will regularly look wrong, early, or inactive. More often than not, there is no applause, recognition, or praise for disciplined behavior. Sticking to this OS means living with skepticism from others. Another major cost is ego starvation. There are no heroic decisions, no dramatic stories, and no identity reinforcement. The professional investment OS quietly dissolves the ego instead of rewarding it. This is why most quit, not from system failure, but because their psychology isn't fed. Most people ultimately quit not because the investment system fails, but because it doesn't align with or reward their psychological needs. The hidden costs, boredom, delay, discomfort, and ego challenges are too high for most to tolerate over the long term. Take a moment to notice what this way of investing truly requires. It doesn't demand superior intelligence or brilliance. Instead, it asks for emotional neutrality and consistency over long periods, especially when no one is watching or cheering you on. Most people dramatically underestimate how rare that kind of emotional neutrality actually is, staying consistent, unemotional, and steady, while others react emotionally or chase excitement, is the uncommon trait that determines long-term success in this domain. Here is the insight that reframes everything. Professional investors are not obsessed with winning trades. Instead, their number one goal is simply to survive and stay aligned with their system. The market rewards survival, not ambition or risky bets. Once you see it, you realize most investment losses come from poor behavior, not bad analysis. Most mistakes are emotional, not intellectual. Investors fail mainly because they override their own systems under pressure, not because the system itself is faulty. When pressure is highest, the market does not test your knowledge. It tests your inner architecture, the systems and habits you have built. In these moments, you must act according to your design or fall back on unpredictable human instincts. You now know something that cannot be unknown. From now on, every financial decision quietly asks, are you using the default human operating system, or are you deliberately running the disciplined investor OS? There's no halfway version, no workable hybrid. The market is extremely patient. It will wait, silently and without judgment, until you decide which system you're running. And no matter your choice, the market will charge you accordingly. This is the line you cannot cross back over.